When planting season begins on a rural farm in Myanmar, the demands are immediate. Before a crop is sold, farmers need fertilizers, inputs, and labor to manage massive physical work. That requires cash up front. In a formal economy, you would secure that capital through standard banking. You'd schedule a meeting, undergo a credit check, fill out a lengthy loan application, and provide legal collateral. But rural farming doesn't operate with paper trails. Many farmers don't hold formalized deeds to use as collateral, and they don't have credit scores. When they walk up to a modern banking window, the system simply denies them service. The very protections that make modern finance stable, legal contracts, verified identities, and risk algorithms, actively exclude the specific populations that need upfront capital the most. This leaves a massive economic vacuum at the base of the agricultural supply chain. Nature doesn't wait for bank approvals. So farmers turn to the local fertilizer shops. The people running these shops act as dealers, brokers, and informal credit institutions, holding the exact inventory the farmers need. A farmer walks in with no cash on hand and leaves with bags of inputs and the seed money required to pay their workers. There are no signatures and no legal contracts. The entire transaction is recorded on a simple paper voucher that costs less than $1 at a local stationery shop. The dealer skips the due diligence because they already know who your family is and how the current season's weather is holding up. They operate on a single piece of geographic certainty. Your farm can't run away, even if you can. We live in 2025. We have access to global internet, instant digital credit, and decentralized blockchain networks. Yet massive portions of the global food supply are financed by a zero-contract handshake system. That system outcompetes modern technology because it isn't built on legal enforcement. It relies entirely on the permanence of physical land and hyperlocal personal trust. This flowchart shows two different agricultural supply chains. The top path is the reality, a complex, multi-step chain relying heavily on a middleman. The bottom path is the ideal, a direct pathway from the farm to the plate, designed by a donor-funded pilot program to cut out the dealer so farmers can keep the full profit. The pilot program had pure intentions, but it shattered upon contact with reality. Formal programs issue funds specifically labeled as crop loans. If a farmer's child suddenly gets sick at 8 p.m., a rigidly defined agricultural loan is entirely useless for paying an emergency medical bill. The local dealer handles that same 8 p.m. crisis differently. They show up at the door with cash and a smile. They don't care if the money is spent on medicine instead of fertilizer, because they are investing in the long-term relationship, not enforcing the parameters of a specific crop. When an unexpected drought hits and the harvest is delayed, formal systems enforce contract terms, penalize the borrower, and route them to a distant call center. The local dealer simply rolls over the debt, knowing exactly why the crops are late. The direct farm-to-plate pilot failed miserably because it optimized for strict bureaucratic compliance. In rural agriculture, survival requires a financial system optimized for human elasticity. If there are no contracts, a farmer could easily take a dealer's upfront cash, use the fertilizer, and then turn around and sell the resulting harvest to a competing middleman. In a formal system, this breach of contract triggers a lawsuit. The dealer, possessing no legal recourse, reacts with customer service. They don't get angry. Instead, they gently remind the farmer to come back next time, often buying them lunch or dinner to smooth over the relationship. Retaliation ruins future business. In an informal network, absorbing a short-term loss to maintain the lifetime value of a relationship is mathematically more profitable than enforcing the rigid rules of a single transaction. The dealer system is incredibly effective and highly empathetic, but it is a calculated risk management business, not a charity, and the farmer pays a steep price for that flexibility. Because the dealer provides the initial capital with zero guarantees, they absorb the total risk of a failed crop. To compensate, they dictate a fixed, non-negotiable purchase price right at the farm gate. If the crop underperforms, the dealer takes the financial hit. This split bar chart illustrates how that risk translates into profit. The left bar is the farmer's fixed payout. The right bar is the open market. If the crop overperforms and the market price doubles, the dealer hoards the upside. The farmer's earning potential is permanently capped. The gap between those two numbers is staggering. By the time a 40-kilogram bag of potatoes leaves the farm gate, it might earn the farmer $1.50. At the wholesale market, the dealer sells that exact same bag for $15. Consumers pay 10 times more than what the farmer actually earns. This final wholesale stage is where the middleman realizes their massive margin, converting the physical crops they secured months ago into a lucrative cash out. It's an opaque pricing model, and it limits the farmer's upward mobility. But that heavy margin acts as an invisible insurance premium. It is the cost farmers willingly pay to access a functional, reliable financial safety net that operates entirely outside the law. It's a calculated sacrifice. Farmers trade away fair market value and transparency to secure speed, reliable cash flow, and a dealer who won't foreclose on their land when it doesn't rain. A direct, transparent system where farmers earn full value remains the goal for national prosperity, but those platforms cannot replace the current reality until they figure out how to replicate the 24/7 boots-on-the-ground presence of a local broker. Until institutions can offer a model that actually works at 8 p.m. when a child gets sick, trust will remain the strongest currency in the last mile of the global economy, and the middleman will continue to be its quiet backbone.